Paying off a 30-year mortgage in just 5 years sounds insane, right? But it's not only possible, it's happening. Most people spend hundreds of thousands of dollars in interest they actually didn't even need to pay. Today, I'm breaking down the exact method on how to crush not only your mortgage, but car loans, student loans much faster without making 3 times your income or living off of beans and rice. Let's dive in. Okay, the secret in early payoff of the mortgage and other loans is in how you're using your cash flow. Remember the strategy of velocity banking. First, you have to diagnose the drain, okay? If you have multiple loans, you're gonna put them through the cash flow indicator method, which is gonna show you which loan to target first, okay? That's gonna be the inefficient loan, okay? Secondly, you have to make sure you are redirecting your cash flow, okay? And that's the step we are on right now. Let's go ahead and make sure the cash flow that we allocate towards the loan is allocated the right way. Now, a lot of you know that if you make, $5,000, your expenses is $3,000, then your cash flow is going to be $2,000. However, a lot of you are not utilizing your line of credit properly, meaning this $5,000 is actually getting divided up into the $5,000, which is leaving you with a $0 cash flow. Instead of being in control of your cash flow on the line of credit, you're giving that control away, okay? Now, if you were to use your line of credit as your new checking account, this $600 would actually be added to your cash flow, all right? The $600 would be added towards your cash flow. Now, let's say you had a cash flow of $2,000. Well, that $2,000 is staying where now? Where is it staying? It's staying within your line of credit. Well, you have a balance, right, of $12,000. So what's paying down that $12,000? That's right. It's the $2,000 that's being parked in there. So $12,000 divided by $2,000 is what? 6 months. Okay. So you'll be in this. Let's just write the formula there. You'll be in this for about 6 months because, of course, 12,000 divided by 2,000 is 6. And we're talking about the velocity term, which is 6 months. You will be in that line of credit. Now, once you have replenished that $12,000, what do you think is the next wisest move? Now, I think this is a great time to let you know that we are going over all of this tomorrow night at 5 p.m. Pacific Standard Time. If you want to sign up for the webinar that is going to be live, all right, and we show you that, we handle your questions. So all you financial advisors that kind of doubt it and you're skeptic, I actually go ahead. I want to encourage you to show up. We are going to answer you live in front of everybody. So please go ahead and sign up for that in the description link below, okay? So the next wisest move would then be to go ahead and deploy that $12,000, right, that you have now towards a greater venture, which would be, right, that principal on the mortgage side, okay? Listen, the more amount that you put towards the principal, the less you have to worry about in interest later. Now, I understand my promise was to get you out of here in 5 years, and this is how we're going to do it, step by step. Now, keep in mind, this is not your money. Oh, this part is powerful, folks, okay? Remember, your credit score or your reputation garnered you in the eyes of the lenders as someone that is capable of handling your money appropriately. And so they entrusted you with this amount of money, whether it's $12,000, $5,000, whatever amount it is, unsecured in this example, all right? Unsecured $12,000. So really, this isn't even your money that you are deploying. But yet a lot of people, man, they get frantic and they say, but CJ, And I'm like, folks, they're trusting you to use your money like this, okay? So that they can entrust you with more. $12,000, okay? Remember, you are destroying that principal payment of $200,000, all right? So whatever this is, right, which is what, $188,000, right? Now that 6% is feeding off the $188,000 instead of the $200,000. That's what makes it so powerful. Remember, we're not paying attention to the interest because we could care less. We don't care if it's 30% because our focus is on balance and timing. Remember, that's what the bank focuses on. Now we are focusing on it as well. After 6 months, because remember, you have the $2,000 in cash flow. Do you remember that? Right. That $2,000 in cash flow is paying down that $12,000, which means after about 6 months, you will have the $12,000 again, which you can then deploy again, making the balance what? $172,000? Excuse me, $176,000. All right. Folks, are you following here? It's powerful because that is going to make sure that this number gets smaller and smaller, the interest, and this number, this side is getting bigger and bigger, which means there's more going towards the principal than to the interest. That's what they want. That's what the banks tried to hide from us, okay? So, and then after the $12,000 is replenished again after 6 months, what are we gonna do? We're gonna deploy it again and again and again until I want you to see the difference in interest that you've saved and the years. That's something you can't get back. They can take your money, you can always make more. They can take your vehicle, you can get another one. But if they take your time, how are you gonna get that back? Let's share with you the difference between paying it the traditional way and the velocity banking way. So after it's all said and done, we do want to calculate the interest and the time saved. Approximately $196,000 in interest is saved over here, okay, when you're doing the velocity banking way, versus your total payments will be $231,000. I'll let you do the math on how much you paid in interest over here. $231,000 in interest, approximately, okay? And the number of years, you know, the stuff you can't get back, okay, at least not naturally. 5 years and 7 months, you are done if you choose to pay it the velocity banking way. And oh, by the way, you capture this amount, this $1,200. What can you do with $1,200 a month? Perhaps go on vacation, perhaps put it in an investment, maybe do some land deals, maybe do some passive income investments. If you need help with that, we know some people that you can talk to. Others are already getting help, in the passive income. But I know the question is then, wait a minute, CJ, you did not calculate the interest, all right, that you have while you're in this line of credit. Come on now, show us what the interest is after it's all said and done. Well, I'll share with you what I've done, okay? I took the $15,000 and I said, man, instead of having the lower amounts when you're paying it down with that $2,000, right? I'm just gonna leave it at the $15,000 and I'm just gonna have the interest as if the $15,000 was the balance the whole time. The whole time. All 67 months. And remember how to do that. Remember, you take the 21% and you divide it by 12. That's gonna give you a number. That number, you multiply it by the balance, and that's going to give you $262.50. So I did the $262.50. I multiplied it all 67 months. You know what the number was? Let's add. $15,750 in interest. So This $236,000 number, that's not the final number. The final number is $251,750. That's the total payment versus $431,000. Oh, and by the way, would you be able to put another down payment on a home? Put another down payment on an investment now that you know how to use your line of credit, now that you know how to use your credit card? Shout out to Velocity Banking Together, right? They know credit card companies that you can use, right? That are very friendly with Velocity Banking, especially if you live in the show me state. They don't have any cash advance fees for that telecom credit union. Folks, I'm just sharing with you, look, these are the numbers. I need you to understand and ask questions, especially those of you who are coming tomorrow on our webinar, all right? Ask the questions because questions are the answer. Do you understand? Now, you don't have to use a line of credit. You can use the savings, and I'm actually going to share with you some common mistakes that I want you to avoid while you are paying all your loans off. Let's get into it. Listen, and I have to say this, okay? Sometimes you do miscalculate your expenses, okay? Let's go ahead and share with you what happens when you do that, right? $5,000 in income, $6,000 in expenses. And of course, sometimes that happens on the Money Max. The Money Max account will actually share with you how to fix these problems very quickly. But for those who do not know, I want you to pay attention to this because this could save your life, okay? This could save your bank account as well. So the negative $1,000 is nothing to be concerned about as long as you have a plan to not do that again, all right? So that negative $1,000, if you have something in reserves, of course, you can replenish it, or you can look at your credit card statements. You can look at those statements. You can ask, right? Maybe Verizon, hey, I can't pay on the date that I usually pay. You don't have to tell them why, okay? Just be like, I can't pay it, hardship or whatnot, because listen, it is a hardship if you can't pay your, right? So just let them know they are pretty flexible. The credit card companies, as well as Verizon and other companies, they are actually very flexible when it comes to them getting paid. So that negative $1,000 can go away very quickly. But I do want you to know there is another pitfall, and that is paying things the conventional way. It's a pitfall. It's for the banks. You're leaking money and you're in debt because it is designed that way. It's not your fault. I need you to understand that. The system that we've been born in is not a system that caters to those who are responsible with their finances. Man, they want you to spend. That's why they increase your credit limits, because they are banking, no pun intended, on you paying in interest. But when you know how to turn the negative $1,000 into a positive, that's when you are no longer needed to them. Does that make sense? And so I want you to look out for that. I also want you to look out for prepayment penalties. Make sure that when you're paying your mortgages off, when you're paying your car loans off, whatever loan it is, that there are no prepayment penalties, or that you calculate for that prepayment penalty. Because chances are it's still better than being in that cash flow sucking loan all those years. Basically, the only thing that I need you to realize is that Velocity Banking is taking your money that you already have and making it work for you. Remember, there is a story in the Bible where there's a man who looks at a certain individual and says, hey, come and work for me today. Hey, you come and work for me today. That's what it's all about. It's about taking the individual dollars, whether it's $100, whether it's $1, whether it's $200 or $300, and making it work for you. Don't have them on the corner just chilling out, all right, and doing the various things like losing value. We want you to take that dollar and make it multiply for you. You can use the same dollar not only twice, you can use it multiple times if you know how. If you're still in trouble with how to actually do this, there's a video right here you can watch. God bless you, and we'll see you in the next video.